There's one huge problem with ASML. Google just had great news, and a stock that I've been wanting to get into has had a pullback. We have a few things that I want to talk about today, so let's just get right into it. So, I'll do a really quick rundown of ASML if you're unfamiliar. Basically, they're the only company in the world that makes EUV lithography machines, and long story short, without them, we wouldn't have Intel, Nvidia, Taiwan Semiconductors, Qualcomm, Broadcom, Tesla. Technology as we know it just wouldn't be the same without them. So they basically have unlimited pricing power. They're a great company that makes a lot of money consistently, and they're actually my biggest holding in my portfolio. But the one huge problem with them as a dividend investor is that it's an ADR. Because it's not an American company, the version of the stock that I'm allowed to purchase is essentially just a certificate that matches the stock price. It's kind of like if I wanted to buy gold, but instead I just bought the GLD ETF. It's close enough to the same thing, but it's not actually the same thing. The problem with ADRs, though, is that to my knowledge, they can't be purchased as fractional shares, and in turn, dividends can't be reinvested. I had to take a long pause after that because that's really, really bad. If you're unfamiliar, reinvested dividends are what give stocks unbelievably monstrous returns. For reference, here's the S&P 500 over the last 30 years with dividends reinvested versus not. I know, the difference is crazy. So how do we combat this? I won't lie, I don't think there's anything I would rather do than just reinvest the dividends back into the stock that I already like. But I do see two options here. The first option is to just use the money you get from dividends and combine that with your actual paycheck and purchase entire shares. The problem with this is that it's way more expensive and most people can't afford this. The second, and probably most realistic option that I prefer, is to just use your dividends and reinvest it into something else. And I know that sounds incredibly basic and like what else would you do? You know what I mean? But I'll get into specifically how I plan to go about this in a second. But I will say in my case, I actually own two different ADRs, which is a real bummer because I love both these companies. But I own ASML and Novo Nordisk, and I personally plan to focus on using my ADR dividends and putting them into higher yield companies that can still grow their dividend. I'm thinking Altria or BDCs and MLPs like Hess Midstream and MPLX. I haven't talked about those on my channel yet, but they all offer yields of 6% plus. And my whole thought process is that if I can't use these dividends to capitalize on the stocks that I really enjoyed in the first place, I can at least start building up some high yield positions with the money that I do get from them. Of course, you don't have to do this. This is just my plan, at least for right now. But if you have a stock like maybe United Health Group right now, you could just put all your excess into them and build that position even more. I don't know. You can kind of do whatever the hell you want with with your dividends. I will say it's definitely a bummer, but it's part of the game. And at the very least, I get to invest in companies that I really like. Even if I can't completely capitalize on their dividends, I gotta appreciate that. Moving on from this, Google just had great news recently. I don't think I've actually talked about them on the channel before, but I believe they're an extremely great company, and I actually own a little over 2 shares of them. I haven't prioritized them that much because they just started paying a dividend and they've only grown it at a 4% rate. Obviously, they can speed this up a ton, but the entirety of my plans for them stem from how their whole dividend situation plays out. But anyways, Google had a monopoly lawsuit taking place, and that caused a lot of uncertainty because there were talks of them potentially having to sell Chrome, which is just crazy to think about. But the judge ruled that they didn't have to sell Chrome, and now a lot of investors' fears have been washed away, which essentially gives Google a runway for a ton of growth. I thought they were pretty undervalued when I bought them, and even now after their rally, a lot of people still think they're really undervalued. They're an extremely high quality company with diversified revenue streams. They own Google Search, they own YouTube, they have a cloud service. If we do a quick run through their metrics, they have consistent double digit revenue and net income growth. Their net income has actually been averaging 20% growth every year for the past 10 years, which is just absurd. They have more cash than debt. And if we look at some of their KPIs, I said earlier that they have a diversified revenue stream. Aside from what I mentioned, they have their whole Google network like Gmail and their phones. They have the hallmark of all great companies, which is consistent subscription based revenue. Think YouTube Premium. And it's growing at a rate of 20%, which is just phenomenal. They have their cloud, which is growing even faster at a rate of about 30%. And then with their smallest revenue stream, we have Other Bets, which is just Waymo. Now, these past 2 years, it's averaged around 14% growth, but it's slowed down a lot to only 2% over the past year. But that actually brings me to another KPI that I wanted to talk about, their weekly robotaxi rides. It's up 400% over the past year and 2 years, but I just want to highlight the fact that they're the only company doing it as of now. Tesla has absolutely none. And if I'm not mistaken, Zoox, which is owned by Amazon, did just start a little bit. But regardless, Waymo has been doing robotaxi rides for about 2 years now, and they're way ahead of everyone else. Going back to their cloud, you might have saw this before I clicked on their robotaxi rides, but their operating margins have been growing. Not only are they finally profiting, but it's growing at a very fast speed. Over the past year, it's up 88%. If we look at just the last quarter, they were at 17% operating margins, and they jumped all the way up to 20.7% in the most recent quarter. And if we jump over to their cloud backlog, this is based on contracts, and it measures the cloud revenue a company expects to receive over the next 12 months. Thank you, Google Search, for that definition. But it's also growing extremely fast by an average of over 30% over the past 2 years. I didn't plan on doing a whole deep dive on Google and running DCF models or anything, but I just wanted to do a quick summary for you. This is an extremely high quality company that basically just got the green light to skyrocket. I think every investor would benefit from this in their portfolio, and if we see their dividend raise a lot quicker, I will definitely be buying more shares, even if it's at the top. The last stock I want to get into today is Intuit. I've been eyeballing Intuit for a while, and I even made a video about it a couple months ago, but it's finally had a pullback. According to the Dip Finder, it's down about 13% over the past 3 months, and if we look at all the valuation metrics on Qualtrim, everything seems to be pointing to undervalued. Taking a look at their price to earnings over the past 5 years, it's definitely well below the average line at about 48. Generally speaking, that's a pretty high PE, but Intuit has sustained these PE ratios for years, and it's just how their business operates. So I wouldn't really worry too much about that. Keep in mind just their historic PE price. Their free cash flow yield is on the higher end, and the price to sales has come down. Now, price to earnings is the only one that seems to be in the more extreme territory, but these are all pointing to the stock likely being undervalued. I'll run a DCF model in just a second because some of these returns it's showing are phenomenal, but I'd like to show you where I'm getting these numbers from. So over the past 5 years, their price to earnings has averaged somewhere between 55 and 65. And the company has had one of the most consistent revenue growths I've ever seen. If we look at their earnings per share over the past 10 years, it's averaged about 26% every single year. That's amazing. As you can see, over the past 5 years, it is a lot lower at about 14.5%. But over the past 2 years, it's sped up a lot with it being up 31% over the past year. And so if we assume a PE of 57 and an EPS growth rate of 23, which is just a little more conservative than their 10-year average, we could see an average growth rate of 27.8% every single year over the next 5 years. That is unbelievable. That is so fast, and that's not even including dividends, which will grow and compound over that time as well. That's not including rate cuts, which will help boost the stock even higher. And that's being a little conservative from the numbers that we have right now. I like to be pretty conservative with these, so I'm going to bump the growth rate in the PE down a bit. If it only grows at 15%, a little over their 5-year CAGR, but half of their past 1-year results, and their PE only gets to 48, honestly, I can't even make it look bad. I'm trying to be extremely conservative with these numbers so that I can give y'all a more reasonable, realistic growth projection, but I literally can't. This company isn't growing reasonably. That's why I believe there's so much opportunity. Even with these conservative metrics, extremely conservative metrics, it's about 15%, which is my target for any stock that I want to get into, simply because of the rule of 72. If you can average 15% for 5 years, your stock price will double. And regardless, 15% isn't bad at all. It's actually amazing. It's actually really, really good. That's almost double the S&P's average, which is the benchmark that everyone uses. This is another extremely high quality stock, and I'm trying to make it look bad, but I literally can't. This also isn't even taking into account the fact that it seems to be growing even faster now than it was previously. And it's done this all in a very constrictive environment where interest rates have been rising for several years. There's currently a 93% chance of a rate cut at the September 17th meeting, and that could boost all these gains even further. This is a stock that, on the higher end, could see potential returns of close to 30% on average till 2030. And I say on the higher end, but honestly, I'm still being a little bit conservative. Saying this is a little ironic because of the crazy opportunity I saw with United Healthcare, but how often do we get opportunities where the average is 25 to 30%? That's ridiculous. I definitely plan on putting money into them with my next paycheck, and I might even sell some shares of companies I don't plan on being in for the long term, like InnoData, for example. I'm up 60% on them right now, and I'd love to be able to plow that capital into a stock I have a lot of faith in over the long term. I know I've talked about a lot in this video, but let me know your thoughts on any of it, especially regarding the whole ADR situation with ASML. If you know of an even better strategy, I'd love to hear it, but I hope you got something out of this video. If you did, consider leaving a comment, consider subscribing. I'd really appreciate it. Good luck on your investing journey.